7, 6, 5, 4, 3, 2, 1. Hi, everyone. So we are here with Terry Hamel. If you've done a short sale, either as a realtor or as a person, you've probably heard of Terry Hamel in San Diego. Terry, you want to introduce yourself?
Yep, Terry Hamel, my group, RE Market Solutions. We've been doing short sales since the end of 2006. Done almost 3,100 of them that we've closed over that time period. So quite a few.
Nice. And so for people that aren't aware, a short sale, the basic of terms, is when you're selling short of what the property is owed on the property. So the property is worth less than what's owed on it. So Terry, kind of give it a little background before we get kind of going. What got you into short sales?
We actually started trying to help some of our actual clients that we had sold properties to that we had one guy that was going blind and lost his company. And this was back before everything crashed back in the end of 2006. The market was here in North County in particular was starting to soften. And they had just bought the house 6 months earlier. And he went blind. It was a genetic disease really quickly. Lost his business. You know, apparently you cannot run a trucking company when you can't see. We had to sell his house. Right after that, we had one with one of our clients passed away. And had a reverse mortgage. And that was back when they would allow you to get very large loans, and the house had a cracked foundation and couldn't sell it. So we got into it kind of by accident, helping our actual clients that we sold stuff to, and started getting other realtors who represent the buyers on our properties say, hey, look, I'm taking a listing that's going to be a short sale. I don't want to do it. I will pay you if you work the bank for me. And that's really how we got started. And I mean, it was literally that simple. The group I was with at that time, the guy that was running it did a lot of seminars. So we got some business from the seminars and whatnot. And we moved on from there and have been doing them ever since.
And how many short sales have you done? I don't know the number. I mean, I know it was a very big number.
Yeah, we're close to 3,100 that we've closed. And we're not a huge team. There's like, at the height of our team, we had 4 people. We've got 3 right now. But, you know, there were 3 years that accounted for almost 50% of that number, 2010, 11, and 12. I mean, we're almost 1,500 in those 3 years alone that we closed.
And so for people that are watching, again, to dive deeper into the short sale process, I mean, the way I break it down to the easy of terms is basically the bank wants to know what the value of the property is, that the seller, the owner of the property, can't satisfy the need anymore for the payments, and basically that the new buyers qualify to purchase it.
Correct, yeah. And there's some other stuff that's run in the background to make sure that the buyers meet federal guidelines. And when I say meet federal guidelines, they're all Patriot Act. You know, they run them all through Patriot Act to make sure that there's not money being laundered into the purchase. That's all done behind the scenes. We don't even see it unless there's an issue. But so the buyers generally pre-qualified by the short sale lender. They make sure that, hey, you've got a loan that you can get, and federally you pass muster, and your offer is good enough to satisfy what the investor wants for the mortgage. Most people don't realize, but the bank you pay your mortgage to rarely owns your mortgage. It's usually owned by someone else. So your bank that you're paying your monthly mortgage to has to deal with their investor and stay within their investor guidelines. So, you know, they make sure, you know, that all of those pieces fit together. And if they do, and it's beneficial for the investor to do the short sale rather than foreclose, they'll go with obviously the short sale.
And anyone watching right now, if you have any questions, short sale questions, feel free to comment. We can ask Terry at this time. So what's your take on I know we briefly talked about it before we got on camera with forbearances, everything kind of going on now, and
yeah,
after this kind of slows it down.
Yeah, so coming into the whole COVID crisis, we were already starting to move into a recession, and we were already starting to see the default rate go up. At the end of March, so the end of the first quarter, it was about 4.36%, somewhere in there, which is still low historically, but was high compared to where we were at the end of the first the last quarter of last year. So we were starting to see it go up. The second quarter data obviously won't be out until the end of July, but we've seen some preliminary stuff, and it's depending on who you want to believe, because I question some of the data. Some of the data I've seen seems to suggest that they think that the actual default rate's now above 8, and that does not include the forbearances. But I really want to see that data first. I think a lot of people may have gone into default for a first month and then went into a forbearance. So there's a question as to if any part of that data is actually forbearance data.
8% in all United States?
Yeah.
Oh, wow.
Well, if you look at it, we've got here in San Diego over 30% unemployment. So it really shouldn't surprise anyone that it would be, 8%'s not, shouldn't be, may not be out of the question. Now, not all parts of the country are experiencing the unemployment that we are here in San Diego. And the biggest reason that San Diego is really getting nailed is because our tourist industry has been destroyed because of COVID. People can't fly here. People can't vacation here. Our restaurants, bars, nightclubs, all of our attractions have been shut down. They're starting to open. So hopefully we're going to start seeing some people come back to work. But unfortunately, some of those folks aren't going to have jobs to come back to. It's just, as we were talking about earlier, some of our favorite restaurants have already told everyone they're not reopening. It trickles down from there. That means, the suppliers that supply those restaurants don't have the business, so they're not going to be hiring. People that have been laid off won't be called back. This is, it's because of the amount of industry in San Diego that was based on tourism. This could be a year or two before we come out of this. Assuming that we don't go back into another lockdown or we don't see a deeper recession.
What's your take? Because I know previously when someone was in default, right, they had Keep Your Home California, at least for us locally here. Do you think we're going to start seeing those kind of grant programs coming back?
Maybe. And I say maybe because remember it took 4 years, 5 years of a downturn before they even brought Keep Your Home California out. I want to say 2013 is when it finally really rolled out, maybe. Maybe. It depends on the political climate more than anything else. And, I really can't tell you if that's, if it's going to come around or not. I mean, most of Keep Your Home California has been dismantled because they ran out of money several years ago. They still have a servicing arm for the loans that currently exist, but they don't have any real way to, unless they get a lot of federal money, to start that back up again. I would hope that the federal government would not wait as long as they did last time.
So people watching right now, yes, the foreclosures are put on hold for the time being. I mean, at least till next month. We currently have for pre-foreclosures in San Diego County, 841 pre-foreclosures and then 393 notice of sales. Terry kind of brought that up in that little window right there that we had. So Terry brought that up before we got in there. People were able to sneak in the foreclosures, illegal foreclosures. You want to dive into that?
Yeah. We've had a couple of lenders that foreclosed once the moratorium was put in place. I mean, they already had notice of sales against the properties, but the banks went ahead and foreclosed anyway. And it wasn't a lot. I mean, we had a couple. I just found it odd that they claimed that they auctioned the property at the courthouse here in El Cajon, but the courthouse was cordoned off. You couldn't even get close to it. So I'm not real sure where they did the auction at. The bank took it back, so there wasn't even an investor there, and this would have been an investor quality house to purchase. The bank just took it back. I think that they just decided they wanted it. They tend to be the banks that have not been heavily fined yet. Those that have been heavily fined, SPS being one of them, they actually have stayed away from the foreclosures. I think they're a little gun shy about what California could do to them. These were mainly smaller lenders that were servicers that were doing these foreclosures.
So Maribel put a question out there. When do you think properties will start getting foreclosures? Do you think July is going to be the date, or do you think we're going to start pushing it back again?
Yeah. And as we talked about before, a lot of people that did forbearances, if you did one early on, you've already gotten your notice that your balloon payment's due in June. Some of the service, and the sad thing about forbearances and being able to roll them into loan modifications and things like that, really doesn't have a lot to do with the investor, even if the investor is federal. Because as we saw during the last downturn, some of the larger servicers told Fannie Mae, Freddie Mac in particular to pound sand. They put down an edict and they're like, no, we're not, we have a contract. We're not changing it because you want us to. We're foreclosing anyway because we want our money. The servicer wanted their money. I have an unfortunate feeling that we're going to see that again. We'll see how bad it gets. But like I said, we've already fielded calls from people that have gotten the notice that it's time to pay their forbearance back in a bulk sum. And a couple of them have called into their lender and been shot down for any type of repayment plan. And Wells Fargo is the one in particular that seems to be somewhat ruthless right now. I'm not real sure why. They just are. It is what it is. I think that for those that cannot get a workout done after they've done their forbearance, I think that you'll see a 1 or 2 month period where a workout is attempted to be done. If they don't have any income, it's not going to go well. And then we're talking, let's assume that we're talking mid-September. They'll get what's called a debt validation notice. Mid-October to end of October, they'll get an NOD filed, maybe sometime in November, December. They'll get a notice of default filed. So we're going to start seeing over from probably August on, the number of NODs filed start to increase somewhat a fair bit.
Do you think it's in November on?
No, I think we're going to start seeing it actually in August because a lot of people just didn't even apply for a forbearance. They didn't watch the news or didn't get the memo, and they've been in default already. And the lenders have reached out to a lot of folks. One thing I will tell people is, if you get in trouble financially, call your creditors, let them know, try to get into a forbearance. You can do it for credit cards, you can do it for automobiles, for mortgages. But what you need to do, and this is really, really important, so I'm going to look straight in the camera. You need to understand that your creditor wants money from you. So you need to take copious notes when you talk to them. The time, the date you'd called them, who you spoke to, and exactly what they said. You understand that every time you call, you're going to talk to someone different. And if the last person didn't put good notes in or told you something that wasn't necessarily true, and most of the time it's not because they're trying to be nefarious. They're not trying to rip you off. The people that answer the phones aren't paid enough to care about ripping you off. They may not be trained real well. You need to take really good notes so that if a problem arises, you can bring it up with management, or you can file a federal complaint and say, on this date I was told this by Jenny, and her ID number was 76 whatever. Keeping those good notes is really important to keeping your house. Be very careful about believing 100% of what you're told from your lender. And once again, oftentimes it's not that they're trying to outright lie to you. It's a lack of training and honestly a lack of understanding of how the front end works. Remember, most of these people that are answering the phone oftentimes aren't even in the United States. They're in India or the Philippines. They don't get a lot of training over there, guys. It just is what it is. So take good notes. You need to be an advocate for yourself to keep your house. If you want to keep your house, you're going to need to, and you can't make payments. You've gone into forbearance. You need to fight. It could become a full-time job, honestly.
Yeah. Even, if you're looking at a modification on your property, the paperwork and the time that goes into putting the modification together is very similar to the stuff that's required for the short sale.
It is. It's actually identical. It's actually identical. I would also caution people for a loan modification, don't pay someone. One, it's not legal in California to take an upfront fee. 9 times out of 10, when you pay that, you never see or hear from the person again. I know it seems very exciting to have someone that quote unquote you're going to give $2,000 to that's going to save your house. The unfortunate thing is both Vinnie and I have seen what happens in those cases. You end up losing your house. There's plenty of resources online to help you on how to navigate a loan modification. I recommend utilizing them. I recommend calling your lender. Just like I said, take good notes. And if something sounds too good to be true from your lender, check online. Their HUD has guidance counselors that are free. Call a free HUD guidance counselor. They will be very blunt with you about whether or not what you've been told by your lender is real or not real. They're not going to sugarcoat it. They don't have time to. But like I said, if you want to keep your home, you're going to need to be your own advocate. If you're in a position where you're going to have to move out of state and it's just not going to work and you're underwater, all of a sudden, you got to call someone like Vinnie to list your house and get it sold.
So talking about modifications and short sales, what do you think the rate of acceptance on modifications is compared to actually losing it?
It varies. I mean, it varies widely by lender. Some lenders are very happy that they have a very low approval rate. Like Wells Fargo touted it for years. They were very proud that less than 3% of the people that applied with them, or whatever the number was that they cooked and put out, actually got approved. The upside to that is that they also had a very low redefault rate, because when you don't approve anyone except for people that have stellar income all of a sudden, they don't redefault. The downside to most loan modifications is a high 70% redefault, because it's not really a modification. A lot of times it's putting a Band-Aid on a shotgun wound. And when your payment's higher than what you already could not afford, how is that helping you? I mean, it really is not helping you. It's not helping you at all.
Mareva brought up another question. What about stay of relief? Like, is there?
All right. Well, stay of relief, you're talking about bankruptcy. I'm assuming that's what you're talking about. And it's, if someone's in a bankruptcy and the lender files a stay, you don't see that much in California, because our bankruptcies, first of all, are only, 60, 75 days at most. And quite honestly, we're a non-judicial foreclosure state. So why spend the money to have the attorney go in and fight for a stay that may actually drag the bankruptcy out a little longer, when you can allow the bankruptcy to wrap up and then continue with the foreclosure? Because most people don't file a bankruptcy until they're already in foreclosure. So you don't see, we do see some, but it's not real often, unless it's a bankruptcy. Yeah, if you're filing bankruptcy, you're going to get an extra 60, 75 days in the house. Like I said, the stay of relief is something that the bank would actually file in order to get the house taken out of the bankruptcy so they continue the foreclosure. They would make the argument that there's no value and request that the trustee release the house from the BK so they can finish the foreclosure. So most banks don't want to spend the money to do that. They just don't. When bankruptcies are fairly quick here, and we're a non-judicial foreclosure state, so it's not like New York or out on the East Coast where it can take a year and a half, 2 years to do a foreclosure. Here it's 111 days. I think the average out there peaked at like 560 days or something from the time they started the court case out there. We're much quicker today. And Maribel, I see that you asked, or that you said that it happened to one of your clients today. How long had they been in bankruptcy? Because if it's a long drawn out bankruptcy, you may actually see a lender file a stay.
If you're just joining us right now, we got Terry Hamel. He's done over 3,100 short sales in San Diego County. If you're underwater, you can't make your payments anymore. It comes to the idea, might want to look at the idea of short sales. So again, if you're watching us, feel free to comment on here and ask any questions. So Terry, what have you seen from when you first started doing short sales to now? Have you seen a difference in the process of foreclosures and short sales dealing with the bank?
Yeah, it's night and day difference. In fact, it's one of the reasons why we've stayed in it as long as we have, because it's definitely not boring. it literally changes. At the height of the market, it was changing every 2 to 3 months. It was a totally different playing field every 2 to 3 months. When I started doing short sales, it was not uncommon to have to deal directly with a vice president at a bank to do them, especially for the smaller banks. I mean, I remember one short sale we did with a local credit union where, I don't want to make light of this, but it was almost like first of all, the approval letter was handwritten. And I think it was actually on, because it was a Xerox that was then sent to us on a cocktail napkin from a golf course, which I had to politely tell him that no title company was going to accept that. It's changed quite a bit. We've moved from actual upper management in small banks in particular working short sale files to them actually using outsourced loss mitigation and things like that. We moved from every bank having their own paperwork to the height of the market when the federal government came in and started paying them to do it in a streamlined manner, having streamlined, normalized paperwork where everyone used the same type of federal paperwork. And even during that program, the paperwork changed, but it changed for the entire industry. It wasn't just one bank. We're now back to all the banks having their own paperwork again, which can be a little unnerving, especially when they decide to play we change the paperwork every 4 months and don't tell anyone and want you to get paperwork redone with a whole new form that really hasn't changed. They just changed the date at the bottom. And what it tells me is they're trying to drag the short sale out for whatever reason. There's no reason to have someone fill something else out when the only thing that's changed on the form, when all the verbiage is the same. And we've got several lenders who have been notorious for that. We've come to expect it. We just roll with the punches and move on.
So if someone's not following the rules, that happens a lot where basically the bank is not kind of following what they should be following. I mean, can you what do you do behind the scenes?
One of the things that we do when we work short sales is make sure that the bank is at least following state and federal law when it comes to not only foreclosure, but the way they deal with the clients. Sometimes they run afoul of it, and we always give them a chance to fix it, usually multiple chances. We usually actually try to help them by telling them how to fix it and how to stay in compliance, especially with California. We've got somewhat complex laws here. If they refuse to do that, or they do something that is unethical, we will turn them in. I mean, we'll file a federal complaint. We've caught banks defrauding the federal government multiple times, and they're all the big ones or the worst, especially during HAFA, telling your client that they didn't qualify for the HAFA incentive, but for some reason wanting them to still fill out the HAFA paperwork. Well, it's because they were turning it into the federal government to get paid. They were stealing the money from the homeowners. That's what they were doing. Keeping them on track. Also, the squeaky wheel gets the grease. Usually most of these departments are run very lean as far as employees. So, I mean, if we just let it sit and organically get done, it'll never happen with some of these lenders. They just won't finish the file. They'll keep foreclosing, but they won't finish the file. So a lot of what we do is just, keeping the file moving forward. And then when they do something wrong, getting them to correct it is the biggest thing. Especially if they violate their own investors' guidelines.
So, this is a question that I'll get a lot when I'm talking to homeowners. What if an HOA is doing the foreclosure process? What's the process of that?
Yeah, HOAs are a bit different. So in California, when you are foreclosed upon by your lender and they take the house to the courthouse steps and auction it, it's done. You don't own the property anymore. When an HOA forecloses on you, it's a little bit different case. Let's assume that tomorrow you've got a foreclosure auction by your HOA. Whoever buys that note, and they almost always go back to no one buys the debt from the HOA. For this reason, HOAs in California, you've got a 90-day redemption period. So during that 90 days, you can bring your HOA current or work something out with them, and then title will not change as long as that's done within 90 days. You don't have that ability with a mortgage lender. Once they foreclose, it's over. In fact, it's only HOAs. Other types of debt can foreclose on you. Judgments could try to foreclose on you. You don't see that very often in California. I personally have never seen it. It's possible it could happen, but I personally have never seen it. But HOAs are a different story. As with everything else, if you're behind on your HOA, one of the reasons HOAs file for foreclosure is usually because homeowners never call them and talk to the management company to arrange a payment plan or even inquire about a payment plan. Don't be afraid. I mean, the worst thing that happens is they're mean to you and they say, "Hey, pay us." That's the worst that happens. They're not going to take away your birthday. Just call them. Come at them like a human being. Tell them what the problem is. Tell them if it's long-term or short-term. What you're going to do to try to rectify it. Can you get on a payment plan? By doing that, a lot of times they'll waive penalty fees. A lot of HOAs just want to know they're going to get paid. You may be able to save a lot of money by just making one phone call to them. They may be able to work something out with you because they really, there's not much they can do with your house. Once they take it back, if that 90 days is up and title reverts to the HOA, then they're going to try to evict you if you're still in there. There's a moratorium on evictions right now, folks. They're not evicting you anywhere. Let's assume that they foreclosed on you on January 1st. You're not going anywhere right now. They can't even file the eviction to get you out of the house. So it behooves them to try to work, with you or work with a payment plan. Explain to them, what's going on. That's the biggest thing that we run into and it's the thing that actually gives me heartburn is when we see someone that's losing their house because they didn't make a phone call that they should have made early on, and they lost the house for no reason other than they just didn't make a phone call, didn't talk to their debtor or the debt collector.
What's the process if you're in second position or third position?
They can all foreclose, obviously. Whenever a junior lien forecloses, any lien that's superior to that, in other words, is in front of them, still stays in place. So they may take title to the property, but those other senior liens can foreclose on them. So there can be a situation where if you have two mortgages, you can end up with two foreclosures on your credit if they both foreclose on you. In other words, if your junior mortgage forecloses first, and then they don't bring the senior mortgage current, the senior mortgage forecloses on the junior mortgage, you're still on the hook for that senior mortgage if the junior forecloses. And it can happen fairly fast. It can be, we've seen situations, and this doesn't happen often, where a junior will file for foreclosure and then 2 months later the senior mortgage will file and they'll foreclose. It happened to, I'm sure the state, probably not maybe the state's got statistics, but more than likely title companies, you could probably look from a title company and see on properties when trustee sales were filed and when, it was showing that the properties became bank owned multiple times in a short period of time. You're not going to see many of them though. It just doesn't happen often. Usually a junior lien, if they're underwater, and the first is also underwater, won't even foreclose. They may threaten and may file, but they usually won't carry through with it. There's no benefit to them. And actually, they're wasting money. Why take a house that you can't resell because it's underwater on the first?
Yeah, sometimes they don't look at it. I had a client that I was talking to that he got foreclosed on by the third position, and the other one was underwater. So I guess the person that looked at the numbers didn't realize that. So
no, and they may have done a drive-by or done what's called an automated value, aka Zillow. And on Zillow, it looked like the house was worth $800,000, but everything in the neighborhood selling for $5 million. It's a problem with Zillow. Zillow doesn't take into account that your house is literally right next to a freeway. Their algorithms aren't that good. They're horrible, actually. They're almost never right. And I hate junior lien holders that actually use Zillow. And there are a lot of them that do, that will argue, you'll have a first trust deed, a first mortgage that will actually send an appraiser out and bring a value in at, I'm just going to use an example, 500. Zillow says that's worth 625. And the junior lien complains that you're selling it too low. Well, our automated value says it's 625. And we always look on Zillow to see what Zillow comes up with and say, well, you're using Zillow. I can send you a copy of the appraisal from the first mortgage. It's not worth that. You guys didn't do a real value.
Now, how is the transition for investors? Because it seems more and more, especially when we used to go door knocking, was more and more packages that looked like it was from the bank, but actually it wasn't from the bank, it was from an investor. How has that transition your business? Has it had any effect on your business, anything like that?
No, not really. Not really. I just caution everyone that once you do go in default, be very careful with responding to anything that looks like it came from your lender. Don't call phone numbers on stuff you receive in the mail that is questionable as to whether or not it's from your lender. Go online, get the 800 number, call that. Make sure that was actually sent to you. There's a lot of, as this market softens, we'll see all of the fraud people come out, and they want to prey on people that are desperate to keep their houses, and they will take your last $2,000, and they do not care. They will do it. If the call sounds like it's coming from outside the United States, especially hang up. It's fake. They're trying to defraud you. If the call comes on Sunday, hang up. It's fake. They're trying to defraud you. Those are the best things I can tell you. Just be very careful about what you respond to in the mail. It may not be real.
We've got a question. Is Zillow aware of the irregularity of the algorithm? I imagine it'd be hard.
I think you ought to ask their CEO when he sold his house why the Zestimate. Do you remember what it was? It went around the realtor community for a while. It was a big joke. It was a huge disparity. I mean, his house was worth. I'm just going to make up the number because I can't remember. 1.8 million. He sold it for 1.2 or something like that. Automated values are hard, and as much as I would love to pick on.
In newer communities, I think it's more possible. I mean, if they're newer communities, they're more model matches, then usually the algorithm is fairly good.
Especially if it's in an established area that doesn't have freeways and things. Part of the problem with automated values is it doesn't understand that it draws a circle around the property, and we're going to use a mile as an example. It doesn't understand that the closer that the house gets to the major freeway, the 8-lane freeway, the less of value it has. It doesn't understand that. So it's looking at houses that are still within that radius and saying, well, all these other houses sold for this. And if you don't have a lot of houses next to the freeway that have sold as a comparable, it doesn't get that. It's, honestly, whenever a value needs to be done on a home, it should be done by a human being that knows, a licensed realtor that knows the neighborhood and knows the ups and downs for the location of that property. Automated values are always going to have an issue because of that. They always will, because it's, there's no human intuition there. You don't know. It has a hard time discerning that the community built in 1950, the houses are only selling for 500. 2 blocks away, the community built in 2019, which have all current stuff in it, including all current fire code stuff in it, are selling for, 250, 300 more. It doesn't understand. The software doesn't understand. It sees the difference in age, but it doesn't qualify all of the upgrades that have gone into the new construction versus the older construction. So I guarantee the older construction doesn't have sprinklers. I guarantee it doesn't have hardwired integrated smoke and carbon detectors in it. Those are not cheap. It's not cheap. I mean, that alone can add, in a large house, can add 50 grand.
So to jump back into the foreclosure process, let's say hypothetically someone tries a short sale or they forget about the property and just let it go to foreclosure. Once the property is taken back, if it's not sold to auction step, what is the process of the bank putting it back on the market? If someone saw that there's a property that was foreclosed on, is there a way to reach out to the bank directly? Do you have any insight into that stuff? Yeah,
the answer is no. There's not really a way to reach out to the bank directly, unless the bank has a website and they list their coming soons on it. Usually what a bank will do is once they take it back, and believe it or not, sometimes they don't know who the owner of the note is. The note was sold overseas, and they were fully delegated and told to take it back if it went into default, and they're trying to track down to get, because it was sold without anyone telling them. It's one of the problems that we've had with stuff sold overseas. It tends to be traded like baseball cards. They'll take it back, and if it's a very clear line of who owns it, and they like Fannie Mae or Freddie Mac, and there's no title issues, they'll throw it back on the market fairly quickly. Now, fairly quickly for a bank is still usually several months. If there is a title issue, it could be longer. I mean, those at the height of the market, we saw stuff that sat vacant for years. And, you could never figure out why. The bank took it back, but you could never figure out why it didn't go back on the market.
Well, and there's sometimes, too, that a property is in default, and they actually never let it go to foreclosure. It's vacant, and they never actually put the notice of sale on the property.
Yeah, it's the rule of thumb with foreclosures is whenever you want them to go slow, they go fast. And whenever you want them to take the house, they won't. It's just, I don't know why. It's just the way of the universe. There's always a reason why something was not resold or was not foreclosed upon. It's usually a financial reason for the servicer more than the investor. I mean, people need to understand that the servicers are looking out for themselves. They really don't care about their investors or the customer. For the most part, that's been true for a very long time, since the mid-90s. It's one of the problems that we have in the mortgage industry. It's one of the reasons why loan mods are so hard to get. It's in the servicer's best interest to keep you in default as long as possible, because they get paid extra when you're in default. And how often do they reach out? If they do, a lot of times now it's automated. They don't even have a human calling you anymore. They don't even have the decency to have someone from the Philippines call to harass you anymore. It's done it's automated.
If someone is maybe a realtor in San Diego, or they want to work directly with basically a short-term negotiator like yourself, what's the best number for them to reach you at?
619-749-6486. That's our main phone number.
And let's say hypothetically, I mean, they can't get a hold of you, or they're already talking to another short sale negotiator. What are some of the best questions they should ask that short sale negotiator before they actually decide to work with them?
What experience do they have? How many files have they closed? Have they worked with your lenders before? Ask them about relocation money. It can still be had. You have to ask for it. We always do. We don't always get it nowadays. I mean, back in the day, we'd get it almost, 75, 80% of the time. It's gotten a little tougher. Find out what their track record is. How many files are they working? Ask them questions about how quickly their files for that particular lender are closing. I'll quiz them. I mean, I would expect, if someone had questions, we get quizzed by agents all the time. I mean, we're mainly hired by agents to work their short sale listings. And when we get a new client, I expect them to quiz me. They need to know that we know what we're doing. Because if we don't hire. If for some reason you thought we didn't, I wouldn't hire. I mean, the downside to screwing up on one of these is someone's house goes to foreclosure, which isn't a good position to be in. And obviously, the homeowner, then their credit's got a foreclosure on it. There aren't commissions earned by the agents. The buyer doesn't get to buy their dream home. The list goes on and on of people that have been injured by someone not knowing what they're doing.
Well, thank you, Terry, for all the information you provided. If you're watching right now, if you're watching on Facebook, on YouTube, Twitch, Periscope, whatever platform you're watching on, please subscribe to the platform or just follow the platform. Try to bring a variety of different information out there. If you have any questions for Terry, reach out to him. If you didn't get that, put it in the comment section or reach out to myself, and I'll get you his information and love to help you out. Thank you again, Terry, for being on the platform.
You guys have a great day.